What is going on, traders? Welcome back to the Traveling Trader. Happy Tuesday to you. A lot to get into today. The Fed cuts rates in an emergency move trying to stave off the negative effect that the coronavirus outbreak is having on the global markets as well as the markets here in the US. The Fed cut rates by 0.5 percentage point today. I'll tell you why I don't think that was a great idea. And I'll go into a little bit of history of how the market performs after an emergency Fed rate cut, as well as how the markets performed during and after the last few viral outbreaks that we've had, such as the swine flu, MERS, Ebola, and the bird flu. I'll also give you my take on where I think the markets are going to go in the short to mid-term and what you can do about your portfolio. If you are going to enter positions, you have to be very selective about what you enter from here on out. A few positions that we're currently in, our GLD position, this is a gold ETF, is up 12%. Our Tesla position is still up around 20%, looking to exit that for profit soon, especially if we break this 21 EMA here. Made a killing on UWT, which is the oil ETF that is now tanking. Our stop limit hit for about 13% gain as we see oil crashing again. But I'll get into these in a bit. I wanted to go over Bitcoin first and then show you an interesting correlation between Bitcoin and the S&P 500. So let me get right into Bitcoin, and I'll show you why that correlation between Bitcoin and the S&P 500 is important, especially now. We see Bitcoin currently struggling to get above the 8,900 range. It is really hamstrung by this 0.382 fib level here, which is at around 8,900, 8,950. However, this is why I'm not selling Bitcoin here. I think it would be not a very smart move to sell Bitcoin here based on the pattern that is forming. It's currently forming this clear ascending broadening wedge here in the short term, going back to December. And this is verified by the number of touch points that we have here in support and the number of touch points that we have at resistance. This is the pattern that it's in. So the reason that I wouldn't sell here, this is a definite hold for me, is because look at where Bitcoin is currently at. It is right around the support of this ascending broadening wedge. So why would I sell here, right? You have more upside to gain. There's more upside by holding your position than downside. You can obviously think about abandoning your position if the support line breaks significantly, which is also where the 0.5 fib level is, and the 100 moving average on my chart is this yellow line here. So you do have a confluence level here of support, which is even more reason for me not to abandon my position here. Now, if we break all these three, which is the support of the ascending broadening wedge, the support of the 100 moving average, the 0.5 fib level, then yes, you do have cause for concern and you do have justification to abandon your position, potentially re-enter at the 0.618 fib level at around 8,000. But I definitely wouldn't sell my position here. If we take a look at Bitcoin on the weekly, right? Oh, this is hella ugly. Let me just delete some of these fibs. But if you take a look at Bitcoin on the weekly, you'll see that it is currently riding on the 50 moving average on the weekly, which on my chart is this orange line here. So it is currently sitting at the 50 weekly moving average. Also, this broadening wedge that I drew on the 1 day can also be applied here on the 1 week, but it is currently again finding support at the 50 weekly moving average. So there isn't really any reason to abandon post here at support. What's interesting is that Bitcoin seems to be correlated to the markets currently. Historically, it has been correlated to the markets, but in these short-term moves, it's correlating to the markets. So when the markets are tanking or remaining stagnant, you see Bitcoin doing the same. This orange line here, this is the S&P 500. So I wanted to show you this correlation going all the way back to 2011, how closely Bitcoin and the S&P 500 are correlated, which means that Bitcoin traders behave in the same manner as market traders. There might be even a huge overlap, people like us who trade both markets. There are just a few times when Bitcoin and the S&P have acted inversely, but the general trend is correlated. Even this drop here that you see at the end of 2018 when the markets, when there was a view that the markets were going to enter into a bear market, you know, this is when Bitcoin dropped to 3,200, same exact time period. And recently when Bitcoin hit above $10,000, that's when the S&P hit all-time highs. So this idea that Bitcoin is a safe haven when the markets are tanking is not really corroborated by the evidence that we see here. So let us go back to Bitcoin's one-day chart. And if the Bitcoin market and the equities markets are correlated, then we want to see what the equities markets are going to do in the short term. Even though Bitcoin can break away at times from the equities markets and vice versa, we want to use that as a potential data point in our Bitcoin analysis now that we know that that correlation exists. So looking at the SPY, which is the ETF that tracks the S&P 500, we see that Bitcoin has found the S&P has found support at this key support level here. And for those that follow the trade alerts, if you want access to the trade alerts, link is in the description. I did actually send out an alert for the SPY. We longed the SPY after it bounced off of this support level here. We did it through options. Obviously, you could have just bought the SPY on the spot market, but we did it in the form of options, just purely based off of the support that you see here. Now, it is very likely that the S&P will come back to retest this level, retest close to it. We rarely see a one candle bounce off of support, right? The market wants to test support levels to see, will traders uphold that level firmly, or will they abandon their post after retesting support levels? So I do think that there is definitely chance to retest the support level once again. Now, in the long term, I think we'll be fine. I mean, the markets have shown time and time again that these crashes end up being, small blips on the radar, right? And in the grand scheme of things, they really represent a very small time period. I mean, if you look at the SPY chart here, you'll see it's generally one long uptrend, and you have these crashes representing a very short time window in the grand scheme of things. So this is definitely an opportunity to scale into cheap stocks, although I wouldn't go all in very heavy because there is room for decline, especially if we break this support level. So the Fed cut rates today, as we said at the outset, and I don't think that was a great move, because you essentially want to save that ammunition for when things tend to get really shaky, right? There's so much negative momentum about the coronavirus. There's a chance for it to become a pandemic. As a matter of fact, I was reading that the H1N1, which is the swine flu, by the same time period actually had fewer cases of infections than the coronavirus has by the same time period. But within 4 months, the swine flu had already affected 22 million Americans. So the spread of the virus itself can become way worse a few months down the line, 1, 2, 3, 4 months down the line. And it just seemed like this move was too premature, and it was really going against the grain, right? Trying to stave off the negative momentum that was sure to overwhelm it. So it really didn't do much. As a matter of fact, stocks right now, if you look at these percentage drops here, it seems like the declines have even become more accelerated since the Fed announced the emergency rate cut. If we look at the history of previous viral outbreaks, I mean, it shows that even at the swine flu happened, if you remember, that was like 2009. And that was right after the worst financial crisis that we've had since the Great Depression. So imagine we had the big recession and then the swine flu outbreak, and we still managed to rebound by 40% almost within 6 months. If you look at SARS, we managed to rebound 21% within 6 months, 21.5%. MERS, 9%. Ebola, 4.3%. So the data shows that the effect of outbreaks, similar to what we're seeing with the coronavirus, if you take the bird flu, swine flu, MERS, Ebola, the effects are very short-lived, and the Fed didn't really need to use that, one of their last bullets in the chamber in order to try to stave off the slump in the markets, right? Now, here's another interesting chart. This is how the markets perform after an emergency rate cut. This is, by the way, the first emergency rate cut since the 2008 financial crisis. The ones previous to that were mostly during and after the dot-com market crash. So instituting a rate cut now after markets have hit all-time highs doesn't really make sense, and the markets don't really perform very well after an emergency rate cut. Now, this could be correlation and not causation, since most of the rate cuts have happened during some of the worst financial crises that we've had in this country and in the globe and around the globe. But in general, the next 6 months and the next year following the emergency rate cut the performance has been lackluster at best, with only less than a third of the time resulting in a positive outcome. So in my view, I'm already continuing to de-risk my portfolio. I've already exited out of a lot of positions into cash for profit. And as I said, I'm being very selective about what I trade at the moment, right? Just short bursts, quick selective trades such as the Tesla trade, GLD, UWT, of course, the SPY. Luckily, the stock market provides a wide array of methods to short the market, long the market, etc. You can even, play the volatility game. Again, I will be sending all those out in the trade alerts, and I will be sending an update to my portfolio today. So sign up if you want access to that. Anyway, that is it for this video. I hope you got something out of this. Hopefully I provided you with some solid info as well as my takes on what I think the markets will do in the short to mid-term. Again, as far as the equities markets go, in the long term, I'm not worried at all. But in the mid-term, there is definitely cause for concern, especially if these support levels are broken. Sign up if you want access to the trade alerts, if you want to learn how to trade options, do technical analysis, etc., and would like one-on-one coaching with me. Same link is also in the description. Hit that notification bell, subscribe to the channel, leave a thumbs up if you got anything out of this video, leave a comment if you have a question, agreement, disagreement, etc. Stay safe out there, traders. Peace.